Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today we're going to talk about the Primary Vision Frac Spread Count, and then we want to go a bit deeper into the different hydrocarbon demand side, but also look at coal and how that is playing into the electricity mix, how some of it's coming back, and what that interlocking is going to be between the U.S. and natural gas, light sweet crude, high sulfur fuel oil, because they're all really interlinked in some of the key drivers of what we think production is going to be and how much activity is going to come from. And then we're going to turn to what is happening on the U.S. economic front. So without further ado, we have the Primary Vision Frac Spread Count at 279. So we went from 285 to 279. And for those that have been watching, one of the things that I had been saying is that we were going to start to see that seasonal bump. And just to give some color on what that is, so typically after the 4th of July, we have a ramp into the end of July, and then we have a slowdown into August, but essentially taking us back to where we were in June. So not a huge slowdown, just because we have vacation, it's the heat of the summer, and then we have a bit of a ramp as we go into post Labor Day in September through October, and then typically November, December, we start to see that slowdown, especially the 6 weeks between Thanksgiving and Christmas, and then we start to kick off again in Jan. So one of the interesting things here is right now when you start looking at the economics, and it's interesting because as we start to look at some of the different functions, you have to consider where we are and break it into the three different hydrocarbons. Because when you look at crude, yes, crude has come back, but obviously it's still at $97 plus. Light sweet crude is still trading at a premium when you start looking at what Saudi Arabia did in terms of increasing those OSPs. So that's really because they've taken that price up so much, we still continue to compete with Brent. It would make sense, which we've been saying and we've been seeing in the data, that exports remain robust from the US. So one of the things here is when you start looking at the data and that drop of 6 spreads, we have to look at what is driving it. So we had a decline in Denver, which again, is that more of a moving day, or is that something where we did have an increase in the Powder River? So are we seeing some of this equipment go from Denver to the Powder River? And where are we starting to see some additions? So we got it in the Anadarko, which we've been talking about, but we had some slowdowns in the smaller basins as well as in the Permian. But when we look at the Permian, we believe that is a bit more of just a moving day, if you will, going from one pad to another. But we've also had a significant amount of heat. And for those that aren't aware, obviously these are equipment that run hot. They are putting out thousands upon thousands of horsepower, a lot of pressure, a lot of grinding pieces. And again, heat does not do well when you have something that's already generating a ton of friction. So this could also be, we already know that a lot of this equipment has been overworked. We already know that there's a shortage of equipment. So this could also be something that we're starting to hit that top. One of the things that I do expect to see a fairly sizable bump, this is something where it's one data point. Now, obviously it's important. We're not going to ignore it, but we want to see, do we see another slowdown next week, or do we see this number holding true, or is this more of a moving day and we get a snapback next week? I think that's going to be a really important piece, because this could be a pivot, and this is going to be an important one. Again, it's just 1 week. It's just one data set, but it's counter seasonal. It's counter economic. And those are some key things to look at when we're discussing about, okay, well, is this going to become a bigger trend that we have to talk about and really explore? Or is it just one data point, things were moving around, and now we're back on track? So again, just calling this out as something to watch as we continue to cover it. We're obviously going to talk about it, do the analytics, and try to do the hard work to give some guidance on where this could go. Now, on the other side, when we look at rigs, we had an increase of 2 oil, 2 miscellaneous. Again, the miscellaneous could be just about anything from geothermal on down. But when you look at, we lost 3 directional rigs, but we picked up 4 horizontal, 3 vertical. So again, we're still seeing that steady grind up. So you're still seeing rig activations. You're still seeing more work come through. We had 4, and then when you start breaking down the net, we had 4 increases in Texas, 3 increases in Oklahoma, and 1 in North Dakota. But as we've been saying, we believe Texas and Oklahoma are going to be huge drivers of growth, especially Oklahoma. Excuse me. So that's going to be an important one to watch, as we did get some slowdowns in Louisiana and New Mexico. But one of the things that we've been talking about, and one of the pieces for the clients that we've been discussing, Wyoming is getting a lot of interest and is becoming an interesting spot to look at based on the production side, based on some of the shifts that we're seeing in the Midwest, and that's going to be an important one. But obviously, we're also increasing, bringing those ducks back, again, flatlining that duck drawdown, and really positioning ourselves. We do think, at least I think, that there's going to be that additional capacity in Q3, and then we'll get that push. So if, in my opinion, I would say that there is a snapback in some of this capacity, but at this point, I should say in terms of completions, but this is going to be an important one when we're looking at how supply is going to shift. Now, one of the things that we want to look at is obviously natural gas, because it's an important backdrop. And for those that have been following natural gas, to see the back end of the curve without a 2 in the price is definitely a nice thing to see. But one of the important pieces is when you look at the front month. So when you look at the orange piece with that front month, back above $7, we continue to see this, again, that shift up. So given the front month is going to have a lot of capacity to it in terms of the volatility. Especially when you're at $7, you can move a significant amount in a short period of time. We still have a heat wave in the U.S. We still have the problems coming out of Russia, which again is increasing the demand for our LNG. Obviously, Freeport is a little bit of that headwind when you look at the U.S. pricing side. But once Freeport comes back, but even still, we're still in a good spot. I'm going to say big good spot. I mean, we're still slightly below normal on U.S. Natural gas storage. So there is a lot of staying power at natural gas. Now, is there staying power at $7 versus $6.50? I would say, based on the current weather predictions, yes. But I feel more confident when I look down the curve and seeing natural gas, still staying fairly elevated. I don't think we see 250 again. I do think that there is a lot of these shifts. Obviously, if Russia leaves the Ukraine tomorrow, does that mean that that everything's going to go back to normal? Does that mean that natural gas is going to flow? Are we going to take away sanctions? And again, that's something that I don't think is likely, which would obviously be in one of those impacts in that longer term shift in terms of where gas is flowing and how gas flows, because we are seeing an increase in adoption. We're seeing more utilization of it in the U.S. and obviously a bigger demand for it in the global market, which if you look at just the amount of LNG that we're capable of exporting, is going to allow us to capture some of that market. But the pie is getting bigger. So as the pie keeps getting bigger, as we continue to bring on new supply into the LNG market, that'll keep demand elevated in the U.S. and support activity in our natural gas regions. And importantly, on the refrac side, because we do have a report that just came out. We have an article coming out on it in AOGR, where actually the cover story in August, so that's exciting, where we talk about some of these economics on refracs and the different structures that we have going forward. So now when we look at the NGL front, I think it's important because we've been talking about the different back and forth, where obviously we went up to north of $30 when you look at the frac spread, and this is the different frac spread. So you have the frac spread on the completion side, and then the frac spread when you're looking at fractionation of the NGL basket. And you're seeing that there's a lot of staying power here, and we continue to see a lot of these different bellwethers, or I should say counter flows. There's exports going up. We have some local demand coming down, but exports remaining elevated. We're seeing petchem demand in the U.S. dip a bit, especially on the ethane side. But ethane exports, propane exports remain robust, which is, again, that's the tailwind. But then some of that slowing demand on the industrial side in the U.S. is a little bit of those headwinds. So, again, that's why we just think that we stay in this fairly tight band. But when you go back in time and in history, $20, $21 on the NGL side is fantastic. And again, I still think that we're going to maintain that at this point. And obviously, when you look at the demand for U.S. crude, We have more going into the international markets. We have more going into South Korea, Japan. They just purchased. We have additional going into Europe. Now it's so Libya has lifted their force majeure. So that alleviates one of the things. So two pieces: the CPC. The Russian judge said that CPC can stay open, so that takes away a little bit. But again, it's coming from a Russian judge, so they could easily try to put more pressure on Kazakhstan and put more pressure on CPC. But so far, that those flows will remain stable. And just so the General Haftar and the current prime minister have created a bit of a loose alliance. And the reason why that's important is because Haftar is being supported by the UAE, Russia, and to the quiet degree, the U.S. So by them creating this backstop, Salan, the NOC, the individual that was just removed from the NOC, the Santala, I'm sorry, there's more likelihood that this was supported by all sides to create a certain amount of an agreement. So you have the government, the NOC, and the protesters that have made this alliance. Now, again, it just shows how things can change quickly, especially as anybody who's been following the MENA region as much as I have. You understand that the tribal backdrop is important, and that's going to be something to watch as we go forward. Now, as we turn over, but in closing to that, we should see additional capacity coming from Libya, which will help alleviate some of the pressure that has been seen in Europe. Because when Libya came into question, going from 1.1 million to 600,000 in exports, you had them going quickly and buying more from West Africa. As Libya starts to come back, again, still need to see it, that'll reduce some of that purchasing that we've seen from Europe from the West African front. So now when we turn to the U.S., we always like to look at some of the demand factors. And here you can see that the U.S. adults in June, I drove less. It went from 38% to 45%. So we are seeing more people saying they drove less. Obviously, gas prices have continued to fall in July, but diesel prices, while they've fallen, they have not fallen to the same degree, which is, again, the bigger issue when you look at the supply chain cost. But as we're going to talk about, the decline in gasoline prices directly impacts consumer sentiment. And so it shouldn't be of a surprise that consumer sentiment got a bit better, still near the lows, but obviously as gasoline prices come down, sentiment will improve. Now, when you start looking at the Philly Fed data, and we talked about this already, but we just wanted to highlight it again, the manufacturing index, which has turned negative. And what does that mean for non-gasoline demand? Obviously, that we're talking diesel, residual fuel, those two key pieces. It typically means it comes down. But even as demand comes down, we're still at such a low supply level, especially when you look at Pad 1, that even as demand falls, it doesn't mean prices have to collapse. And this is likening back to 2008, where you had prices go from all-time highs to near all-time lows in a quarter. We're just thinking that even as demand comes down, you're going to have to see demand fall further to try to get the same price response, which again is where we see some of this key pressure. And one of the reasons why, even as demand comes and starts and continues to slow, as we outlined in segment 2 of the EIA show, we just don't see the same type of pricing pressure, where gasoline, on the other hand, there's a lot of volume in the global market. There's falling demand on that side, so we do expect prices to fall a bit faster, while diesel pricing does hold in, keeping that pressure on the supply chain. So now when we look at piped gas, obviously Russian pipeline exports of natural gas to Europe have been falling. So when we start looking at some of the different pressure points, you see the drop. This is creating some of that problem, especially because there is a massive heat wave that is hitting Europe as well. There's some records that are being set. I believe there was one in Portugal. I think it was either just today or yesterday. I know I saw it come across in this headline. So that's a lot of AC, that's a lot of air conditioning, that's a lot of demand, which again is going to exacerbate the problem when you continue to look at Russia slowing down those exports. But when you look at exports slowing and you look at LNG being expensive, you're looking at gas, and it should be of no surprise that China has started to look differently at Australia and their ban on Australian coal. as coal continues to go up in price. So when you look at Asia Pacific, coal accounts for more than 20% of global energy use. So when you start looking at ways to impact the GHG question, making natural gas more readily available and replacing a significant amount of this coal is a low-hanging fruit to really start to answer the question, instead of, again, on the smaller side, on LNG, solar and wind. Here's where we can really make a lot of this impact. And as you can see on the global energy consumption by region, surging energy consumption is responsible. Asia Pacific is responsible for almost half of global energy consumption. That's looking at China, Asia Pacific. So when you look at where the most coal is used and the big increase in energy consumption, this is where we believe there's a big opportunity to introduce more natural gas into this, but you need to make it cost effective. And that is the biggest concern, especially as coal, the availability of thermal, the availability is getting limited as we've been shunning new mines, as we've been shunning and shuttering, capacity. You're taking some of this coal off the market, which again is leading to some of these price increases. So this is where we can see some of these impacts, and the way the U.S. and other spots within the Middle East. I know that they're looking at how they can increase their natural gas consumption locally, but also alternatives into the export market, and just to see how they shift that coal trade. When you look at Indonesia and Australia and the amount that they export, and why Australia is so important to that global market, and it's also quality. As we've talked about crude quality, there's also coal quality, and Australia has a significant amount of coal quality. So while China has a lot of in the coal trade, they don't have the best quality in the world. And that's really important when you start looking at, okay, well, if we're trying to reduce sulfur, we're trying to reduce the carbon footprint, the better the quality, the better the burn, and the better the outcome. And that's, I think, one of the big components. But when you look at the amount China consumes, they can't produce themselves. Like you look at Mongolia and that little sliver versus Australia, Indonesia, and the amount that it typically is flowing into China, which is why the shift in terms of, well, how much gas can we make available, why China's been a massive buyer of U.S. LNG in terms of signing new agreements, because they are also trying to address this problem, but also create something that is going to be available and a longer term solution, which obviously we do believe is natural gas. Asia's coal-fired power plants will be working for years to come when you look at the average age of the power plant. And this is the important piece, because typically most of these facilities have a 30 to 40-year life expectancy. And when you look at Japan, who has been building facilities, India, China, they're staying at this level in terms of where that production is. So this is going to be an important piece as to, you're really not going to replace it, but in my private equity fund, we've been looking at some of these solutions in terms of amine systems and ways to capture this flue gas and turn it into a lot of viable products, but depending on the needs of the location, food grade carbon, syngas, hydrogen, a lot of things that can come. So this could actually be a provider of some of the things that we're short in the world, especially fertilizers, food grade carbon, hydrogen, where maybe coal has a place in the world, and we think it does, because some of the solutions on carbon capture, flue gas capture, does provide a long-term solution and provides a lot of industrial gases and industrial products that are viable, that have a great place and aren't being emitted into the atmosphere. And I think that there's a lot of investment and disconnect in terms of the viability, which is why when you start looking at clean energy investment and sustainable debt issuance, it continues to be elevated in 2022. We don't see that changing. We do see a lot of this in the advanced economies, but when you look at China, but more importantly, emerging markets and developing economies, we think that there's a big opportunity to take some of their coal and industrial processing and install some of these systems and produce some of this different capacity. that would capture and alleviate some of those GHG concerns while producing another market and filling other shortfalls on the industrial gas space. And the reason why all of this is so important, and especially looking at the U.S., look at the average industrial electricity price and how it remains elevated. So we continue to take down base load, and some of the capacity that we've been building is more intermittent and not really the base load that we need, which means you're relying on peakers. And what are peakers but more expensive? And so when you start looking at the underlying price, this is also an inflationary driver. This is a cost that is going to be passed down by companies that have to take this electricity price into account. And it's also becoming a bigger issue when you look at Europe, which obviously with shorter natural gas, with not as much piped natural gas, you're creating additional shortfalls. You have to go out into the market, buy the more expensive LNG, which is driving up their own electricity pricing, which is increasing their other types of different different type of costs, which again, driving inflation, hurting the ability to compete in the global market on price, and obviously also hurting their local consumer. So now when we turn to the U.S., you can see retail sales slightly better than expected, coming in at 1% versus 0.9. When you adjust it for inflation, it was essentially flat. When you look at the control group, the expectation for 0.3 came in at 0.8. Nice increase. Adjusted for inflation, still negative. But again, as we've been saying, we're not seeing a steep drop off. It's just the trend has been on a negative level. But this is why when you look at these numbers, they're not this, oh my God, where everyone is living in a cave and avoiding going out. No, there's still activity. And that's why when we look at Q2, we still see a bit of growth, and we still see a little bit of, but again, as we progress forward, as these problems continue to arise, we expect to see a bit more pressure. And if you just look at industrial production, you're starting to see that. As we've been talking about, expectation was for 0.1, came in at negative 0.2. So you're starting to see a little bit of that slowdown on the industrial front. The retail side, the consumer side, as we've been talking about, sentiment is terrible, but spending is still there. And again, you can get this disconnect because the U.S. consumer, the global consumer, is a bit fickle. And so that's where we do think there's slowdowns. We do think there's downward momentum, but you're still seeing a bit of that holding firm. And as we said with the gasoline prices coming down, as gasoline prices coming down, now no surprise, Michigan sentiment went up a bit. So instead of being at 50, came in at 51.1. Current conditions, expectations for 53.7, came in at 57.1. Again, slightly better. There's a little bit of that bounce in terms of where that is going in general. So when you start looking at the retail sales, so retail sales, as we were showing, but then when you look at ex-auto sales, 1% versus the estimate of 7%. When you look at the control group, things were revised down a bit. So last month was actually a bit worse, which means that then because last month was a bit worse than expected, that the snapback was a bit better. So you're still seeing that fairly kind of flattening out. But as we talked about in the econ show yesterday, a lot of the leading indicators are showing the slowdown accelerating, which again, as we start to see, on the wages side, that is playing out the way we've been saying. Industrial production, as you can see, starting to roll over, but still high. Like, we're not saying that things are collapsing. It's just the leading indicators. When we look forward, we're seeing some of that slowdown. The regional Fed data, new export orders, new orders in general, CapEx spend, wage expectations. All of that putting pressure down is going to be a negative contribution. And here's just another example. The U.S. Empire State Manufacturing Survey 6 months ahead. It's the worst since September 2001. So again, it's just a matter of what we're staring down. And we've been saying we're staring down the barrel of a gun. And the question is, how quickly do we start to see this detriment, to see these problems start to play out? And then when you look at the slight bounce in University of Michigan, you're getting an idea of it's still very low, but it's better than it has been. Again, 51 versus 50. Expectations fell to 47.3, but the estimate was for 40. So again, you're starting to see that, and gasoline is a big influencer on the way people feel, the way people view the market. They still see food, they still see other goods, they still see pressure. But again, it's not getting continuously worse. You're starting to get a little bit of alleviation here, alleviating factor here. So again, that's why the sentiment's still there. So the trend is still down on retail sales, but it doesn't mean that expectations aren't going to improve. So then when you start looking at finished goods, again, a key leading indicator, finished goods surged by 18.6% year on year in June, which is not far from the all-time fastest growth of 19.6% in 1974. So to just get an idea on some of the pressure that remains in the system, PPI, the producer price index for finished goods, a key component, still going up, still ramping. And this is, again, a very important piece when we look at inflation down to the consumer, long-term, again, hitting that demand. And here's an interesting piece on wages, because lowest earnings cohort, the wage growth, which is blue in that top left, is nearly 2 times higher than the orange, which is the highest piece. So the lowest earner is making more, the highest earner is earning less. But then when you take it all together, the inflation remains so high that real wage growth is still negative for all cohorts. So even with this increase, you're actually seeing a bigger hit to the high earners. You're obviously seeing a hit to the lower earners, but it's not as much. But again, you're seeing this consolidation. And then when you put it all together, wages spiked higher again in June. Growth came in at 6.7% versus 6.1%. And even with this wage increase, it's still a negative real rate wage growth because of inflation, because of all these problems. And again, this is why we remain concerned, because as wages are starting to slow, we talked about it in the Econ show. We're seeing wages slow. I should say wage growth is slowing. So when you look out in July, when you look at what is expected in the next 6 months, wages are going to come down, which again is going to put even more pressure on the real wage growth and consumer spending. Owner's equivalent rent is going back up. Rent surge across the country. Components for each region. So South is leading with the fastest rent increases. And again, as we've been saying, this is just a huge driver of sticky inflation, which is why we do believe inflation is going to continue to go up. And rounding it out, the reduced harvest area is projected to pull 9% less rice in the U.S. And when you go back in time, we are back to levels not seen since the middle 2000s. So we have had some shocks to the downside, but you're still getting that slowdown. And again, the pressure continues to be there in general. So that's what we have for you today. Hopefully it was helpful. I know we covered a lot and a lot of different things. Unfortunately, I will be traveling for work next week, so we won't have the EIA and the Econ show, but we will have the FSC show. So we'll give you some time to catch up on some of the things that we talked about. We do try to be forward-looking, so again, there's no surprise, so that you can watch this week and it'll still be relevant next week. So, and then we'll be back to our normal, our normal schedule very shortly, or I should say in the next week or two. So hopefully you have some fun things planned for this summer weekend. And again, thanks for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.